What is leverage in spread betting? Spread betting leverage equals risk. Leverage is naturally all about risk, and on markets like foreign exchange and indices, it is quite simple to calculate when spread betting. Trading the FTSE. Suppose you buy the FTSE at £5 a point at 4,500 with a stop loss order at 4,400. Then your risk, assuming your stop kicks in at 4,400, is £500. Your total position is 5 times 4,500 equals £22,500. Your initial margin requirement on this trade would be somewhere in the region of £500 to £1,000, depending on which broker you trade with and whether your stop loss level is taken into consideration. Trading individual shares. More likely where people tend to get confused is when they trade stocks per point. They do, for instance, £10 per point on Marks and Spencer when the share price is trading at 300 pence. The initial margin requirement in this case could be, say, £300, but the total position size would amount to an exposure of £3,000 to Marks and Spencer. So it is the same as if you had 1,000 shares. Now a quick way to help you trade in the beginning is to use this rule. £1 per point is the equivalent of 100 shares. £10 per point is the equivalent of 1,000 shares. £100 per point is the equivalent of 10,000 shares. Sensible use of margin is not something to be afraid of. Abuse of margin in relation to the size of an individual's account is what can get traders into heaps of trouble. For more information, visit www.financial-spread-betting.com.